Welcome. If you're watching this, you know real estate isn't just about buying properties. It's about timing, trends, and knowing where the market is headed next. Today, we're going to map out the next 5 years in real estate, the opportunities, the risks, and where smart investors should place their bets. Because if you're going to build wealth, you don't want to be chasing yesterday's real estate. You want to build for tomorrow's. Let's begin with the macro picture. Right now, the U.S. real estate market is in a slow growth phase. According to J.P. Morgan research, house price appreciation in 2025 is expected to be modest, around 3% overall, driven by tight inventory and limited demand. Mortgage rates will remain higher for longer, with only slight easing. Inventory is gradually rising, but still well below historical norms. That gap between supply and demand remains a structural constraint. So in these next 5 years, we won't see explosive booms. Instead, expect uneven growth, pockets of opportunity, and increasing importance of local markets, asset classes, and strategies. Let's talk sectors: residential, multifamily, industrial, office, retail, and niche real estate, and see which ones will lead and lag. First, residential, single-family, and small multifamily. Because financing is tighter and rates are elevated, appreciation will slow. Some markets may even see flat to mild declines in nominal price in weaker areas. But in supply-constrained, growing metros, especially Sunbelt and secondary cities, you'll see modest 3 to 5% annual gains. Rental demand will strengthen in many areas as higher rates push would-be buyers toward rentals. Multifamily will continue to be a workhorse strategy in many markets, especially where zoning allows density and new supply is limited. Industrial and logistics real estate remain tailwinds. E-commerce, supply chain reconfiguration, onshoring, and demand for cold storage and last-mile facilities will drive growth. Warehouses near dense metro peripheries will be winners. Office. That's a tougher story. Hybrid work models are here to stay. Class A offices in top downtown cores with strong amenities might hold value, but many suburban and secondary offices will struggle. Adaptive reuse, co-working, or converting to residential may become a bigger play. Retail is undergoing transformation. Neighborhood retail, mixed use, experiential retail will outperform dull storefronts. Retail anchored by daily needs, grocery, medical, fitness will be more resilient. Then there are niche categories like data centers, cell towers, life sciences campuses, vertical agriculture, self-storage, and cold storage. These specialized assets will continue to attract institutional capital. For example, CBRE's outlook shows that sectors like data centers, industrial, and logistics are being supported by secular tailwinds. Next, geography and migration trends. One big move: people and capital are shifting toward the Sun Belt and lower tax, lower cost cities. Remote work is here to stay. That means inland metros with job growth, affordable housing, and quality of life will outperform coastal, high-cost markets. Expect population inflows into Texas, Florida, Georgia, Arizona, and parts of the Southeast. That's not speculation. It's already happening. Meanwhile, some high-cost, over-leveraged coastal markets may see stagnation or mild correction, especially where regulation, property taxes, and affordability pressures bite. Let's shift to interest rates and capital costs. This is the linchpin. If rates remain in the 6 to 7% range, deals that once made sense at lower rates may no longer deliver target returns. We'll see more focus on yield, rent growth, expense control, and operational excellence. Some markets and deals will get priced out. Institutional capital will demand bigger spreads over risk-free rates. One of the most powerful shifts I see is the rising importance of micro-market selection and value-add underwriting. Gone are the days of betting broad markets. In 5 years, returns will be earned by those who identify undervalued pockets, reposition underutilized assets, or convert obsolete assets into higher use. Conversions, densification, adaptive reuse, those will drive outsized returns. Another key trend: technology, data, and AI in valuation and operations. The property that's managed with real-time analytics, predictive maintenance, tenant experience platforms, mobile-first operations, those will outperform. Also, with upcoming regulatory and appraisal frameworks, real estate valuation is shifting toward machine-readable, structured formats, combining human oversight with AI models. Sustainability, ESG, and resilience will also matter more. Properties that manage energy, water, climate risk, flood, heat, wildfire, will command premiums. Investors will penalize buildings without climate adaptation. Green buildings, efficiency retrofits, and net zero design will move from fringe to baseline in the next decade. Now, what about risk factors to watch? Interest rate spikes, debt overhangs, inflation surprises, regulatory shocks, zoning, rent control, tax law changes, demographic shifts, a tech downturn that undermines office demand, a cycle of oversupply in weaker markets. Those risks are real, and any one of them can knock undervalued deals into losses. So how do you position yourself as an investor? Here's your playbook for 2025 to 2030. Focus on cash flow and yield, not just appreciation. Identify growth corridors, Sunbelt, secondary cities. Use value-add and reposition strategies. Go niche, data, storage, cold logistics, last mile. Integrate technology, ESG, and predictive operations. Stress test your deals against rate and inflation scenarios. Stay nimble. Be ready to move between property types and markets. To close, the future of real estate won't be about blindly buying in hot zip codes. It will be about discipline, local insight, operational excellence, and the ability to ride macro tailwinds while mitigating risks. If you want to win in real estate over the next decade, don't chase hype. Master fundamentals. Know your markets, build optionality, and always assume you need to outperform, not just keep up. Drop a comment. Which niche property or city are you targeting for 2025? Hit subscribe for deep dives on every sector, every strategy, every deal. And check the description. I'll drop a link to my 10-year real estate forecasting spreadsheet so you can run your own scenario. Let's build for the next decade, not the last one.